Hey folks, welcome to this video. Today I'm going to walk you through a new strategy. So it's called Achieving Consistent Passive Income with Credit Spread and Kelly Criterion. Now before we get started, please make sure you subscribe our channel. So what is Kelly Criterion? I'm sure many of you are already familiar with it. So it is a mathematical formula for betting size, which is frequently used by investors to decide how much money they should allocate to each investment or bet through a predetermined fractions of assets. And here's the formula. So as you can see, we have symbol P and symbol O. So P stands for average probability to win, while O stands for the average odds. Let me just quickly explain what this formula says. So it is essentially computing the expectation of return. Since O is the odds, that's the money you're going to get. So O minus 1 minus P here, so which is your probability to lose. And since we are saying that all odds is for your money compared with 1, so here is essentially just omitting that multiplied by 1. And eventually you divide by O to get the statistical expectation of return. So the main idea of this strategy is to sell monthly credit spread with predefined probability and odds. For example, we have a predefined probability to win of 90% and odds equal to 0.12, which means if we bet $1, we are expecting to get $0.12. Or it's a roughly 12% monthly return. And then we plug P and O into Kelly Criterion to compute the optimal money you should put in. So for risk control, since selling credit spreads are very dangerous, for example, if you are not careful enough, you can simply lose all your money or your bankroll if the spreads become in the money. And another risk is that the market can tank or go up crazily. So there's beta risk. And to solve these two issues, you have to do something like this. So you will open up 100 positions with 1% of your bankroll each. And that is to achieve statistical expectations. So you trade often and you trade small. And another thing you would do is you will open up 50 call spreads and 50 put spreads. This is to avoid beta risk, so that if the market tanks, your put spreads doesn't get crushed. Or if the market goes up crazily, your call spread you don't lose all your call spreads. So here's an example. Let's say you have a predefined P equals to 90% and O equals to 0.12. And that means we want to achieve a 12% monthly return. So what you would do is you will find 50 call spreads and 50 put spreads in the market. Ideally, you should open this up when implied volatility is high. And check out Whalewatch.app to help you find these tickers. And another requirement is that you are not just randomly find these call spreads or put spreads, but you have to make sure that the P and the O are very close to what you determine in the beginning. In our case, they are 90% and 0.12. So you will open up 100 positions monthly, and since they will expire in 1 month, you should repeat the above steps after 1 month. So let's take a look and see what we have done here. So we're essentially just figuring out a way to achieve consistent profit with Criterion in a statistical way that mitigate risks and have optimal positive expectation of return, which is equal to O minus 1 minus P. So you may wonder why Criterion? Because it tells the mathematical optimal bet size given the chance to win and the odds. Your second question, so why do we choose to use credit spreads? So in this case, my explanation is that it is similar to like a casino type of gambling with predefined P and O. And then why 100 of them? The more the better actually. If you can find 1,000 of these spreads, it's even better. In the end, we just want to achieve the statistical result. We want to eliminate the outliers. So check out Whalewatch, because this is a very good trading tool that we designed to help options trader to find signals in the market. You can use it to find credit spreads when they have high implied volatility. And the app is for free right now, and you can take a look. Nothing to lose. Yeah, that's it for today. Thanks for watching this video. I hope you enjoy it. Please make sure you subscribe our channel for more trading strategies. See you next time.